Welcome back to Storytellers in Business podcast. Today I'm with my colleague and friend, Steve Ricchiuto, who is Mizuho's Managing Director and Chief US Economist in New York. Steve is a highly regarded, sought-after guest for global financial media, an author. His most recent book, Deconstructing Credit Cycles, was published last year, and an incredible colleague. His daily incisive commentary and welcome sense of humor certainly make for an illuminating and insightful reading in what could be an otherwise rote day-to-day reporting of numbers. He also makes very bold predictions and is accustomed to being a contrarian in what is a crowded and opinionated space of economists, market pundits, commentators, and talking heads. Steve has spent more than 35 years in the financial services industry, clearly has seen a roller coaster of interest rates, credit cycles, inflation cycles, and what have you. And prior to joining Mizuho 16 years ago, Steve has held very senior positions as a chief economist, head of fixed income research, fixed income economist, equity economist, bond strategist, equity strategist, and a director of fixed income. Wow, that's a mouthful, but certainly gave you a great sense and a very broad spectrum of, I would say, experiences to share with us a conversation today. So with that, first of all, I'd like to welcome you, Steve, to our podcast.
Thank you, boss.
So I'm excited to have you share with folks some insights, given the fact that you are at the forefront of a lot of data and information that the Fed, the regulators, our clients are using to inform their decision-making processes, whether it be accessing capital, making strategic moves, and what have you. But I thought maybe we'd start the conversation with a little bit about your personal journey and kind of what has brought you to Wall Street. And when thinking about this conversation, you made a comment to me and you said, life has found me rather than me finding life. What did you mean by that?
Well, that's exactly the truth. For me, the journey here was nothing I really, planned ahead of time. I was in undergraduate and I was getting out at the time that we were starting to go through a stagflation environment. And the decision was take a menial job at one or two institutions or go where every one of the math majors in the school I was going to, which was Bell Labs, and go take a job there or do something else with my life. And I decided, well, I really like academia, so let me go off to graduate school. Economics turned out to be my course, my path, simply because my thesis advisor from my undergraduate mathematics degree told me I couldn't think in more than 7 dimensions, and that he wouldn't give me a letter of recommendation as a theoretical mathematician. So that then led me to find something else to do. And economics had the beginnings of math in it, so it had equations, it had curves, so I decided to go with economics.
And how has that background as an mathematics and I guess then a credit research analyst have helped shape what has been more of a differentiated approach that you have taken to forming views around the macro?
Yeah, that's a really interesting question. And it really gets back to the first time I was asked to be the director of fixed income research. I was given the opportunity to build the fixed income research department. And coming from a mathematical, quantitative-oriented background, even in the economics community, where we were at the leading edge of using econometrics and statistical analysis to try to project macroeconomic data on a monthly basis, daily, and a weekly basis in the markets, I had to sit there and say, well, what am I going to do with hiring all these credit analysts? And the head of fixed income sales said to me, well, go interview them before you figure you can just, solve all the problems in the world with a model. Go interview them and see what you learn. And I did. I interviewed a whole bunch of them. We eventually hired about 30 credit analysts at the time. And I realized what they were doing wasn't rocket science, but there was an ability to adapt what they were doing in terms of their company-specific analysis to macroeconomics. And that was really a real clear dividing point between being your traditional economist and being sort of the economist that I morphed into. And that's how I got into doing bond strategy. And that also then led me to how I got into doing equity strategy, because it was really out of that opportunity to having to build credit analysts and realizing that the way credit analysts study companies could be applied to studying the U.S. economy.
So we'll talk a little bit about that. So you've had this 35-year history of tracking the economy through its cycles, and this experience clearly gives you invaluable insights and perspectives. So looking back over the years, there have been a few significant economic events, but maybe focus a little bit around the recent regional banking crisis and maybe your perspective on that and what people got wrong, particularly just given that initial fear of perhaps a systemic failure.
Yeah, I think the whole point of the credit risk analysis is to understand that there are cyclical components to credit and there are secular components to credit. To put it differently, credit is a symptom of an aging expansion, credit deterioration, or it can lead you to a reversal in economic outcomes, i.e. you can have a systemic credit crunch. And understanding the difference between the two of those is critical. And the regional bank environment was one where I think it was clearly evident up front that what we were looking at was idiosyncratic risk and more of a problem in a few companies, few banking institutions, than it was as a systemic basis. Because if you were studying the credit of the underlying balance sheets for the household sector, the non-financial corporate sector, or the banking industry, you walked away and said, well, the balance sheet of these banks, the assets they have on their books are their loans, effectively. And these loans are being given to high credit borrowers. So we don't really have to worry about the credit of their loan book. So what happened with these institutions was basically they mistreated their liquidity portfolio. And no credit crunch has ever been generated by a bank mismanaging its liquidity portfolio, because as the system works, regulators and internal regulators are often very much on top of bank liquidity portfolios to make sure they're there for what they need to be. And in this particular instance, clearly in a few institutions, that was overlooked, and therefore it was going to be an idiosyncratic risk rather than a systemic risk.
You're talking about the mismatch between long and short term on your balance sheet. And maybe that stands in stark contrast to the global financial crisis. And maybe talk a little bit about that.
Yeah, the global financial crisis was a very, very different beast altogether, because it was clear there was balance sheet risk accumulating. And it was clear it was accumulating in the household space. And all the argument that was being given for the virtuous cycle of, housing prices continuing to go up, driving homeowners' wealth that then allowed them to borrow even more and more money, all of that didn't sit well, especially in an environment where we were creating no documentation loans. We were giving people 120% loans to value based on the idea that home prices continue to go up, or they're going to put all the money into expanding the value of the home in renovations, and all this would work out well.
I just rewatched The Big Short on a flight back from the West Coast, so yes.
And it's interesting because many people saw it and lost their money before the individuals that made their money, because it was so obvious that there was a fundamental flaw. We were borrowing a lot of money short, lending it long, and we eventually had a rising interest rate environment, which turned the mathematics of that short position upside down and triggered a flight of capital. And as capital leaves, capital gets destroyed in financial institutions. And as capital is destroyed in financial institutions, that's how you get a systemic credit crunch.
Going back to the regional banking, you've definitely taken, that was one of the various contrarian stands that you have taken through in my tenure here at Mizuho. Maybe a question for you is, when you do make these predictions and have these convictions, oftentimes they are not in line with the market and with your competitors or colleagues across the street. And our clients are listening to all of those opinions. And when you're the one standing out, talk to me, how do you kind of stand true to your opinion in a sea of potentially views to the contrary?
I think it's a combination of several things. One is age. I've been doing this a long time, as we kind of indicated at the start of this thing. And so therefore I have a lot of experience that a lot of other people that are doing this don't have. And the question comes up often as to why am I still doing it? And the answer is I really love what I do for a living. And I really do like where I work. And the fun thing is management here is willing to tolerate my out of consensus views. Where I think in a lot of these institutions, and having worked at other shops historically, there's a lot of pressure on a young economist in particular to kind of fold to the consensus view. You know, when you're on a trading floor and you're dealing with traders who have really strong opinions and they're very vocal, it's hard to argue with a series of traders all on your trading floor pushing back on you. I have the ability of, I've been here a long time, I know most of the traders, we have a good respect, a good rapport, and management kind of lets me do what I want to do. But at the end of the day, it comes down to how much do you believe in your model? And this credit approach has been something that has been growing for many, many years in terms of the way in which I do it and the evolution of it. And it has proven to be very, very useful. And it's something most people don't do. And most people don't have time to do it because, to be honest with you, studying credit at a macro level to a certain extent is a little like watching paint dry. You've got to be watching it and seeing if there's any streaks that are developing. But by the same token, you're not going to get instantaneous reward for it. So you have to be fully vested in it all the time so that when a problem does happen, you can assess whether or not the shock that's happening in the system is going to matter or not. Because as we go through economic history, what you discover is the economy is always being hit by shocks. It's only the shocks that cause the systemic problem or the shock that happened just before the recession unfolded that we remember. All the other shocks we forget. And the study we've been doing is basically how do you assess which shocks are going to matter and which shocks won't. And that's exactly what happened with the whole regional bank situation, because for us, it was a shock that wasn't going to matter.
So from my seat, running the banking division, there was much hope for 2024. And yes, deal activity has certainly begun to rebound, but the returns of the market have been very much concentrated with the Magnificent Seven. We've definitely seen an increase in M&A volume, but it's been concentrated in larger deals. And yes, we've begun that pivot in interest rates, but they're still, I would say, at the beginning of that journey. And in some ways, I would say maybe 2024 is the year that wasn't. So from your seat, maybe I could ask you kind of an open-ended question, but what are you looking forward to in the next year? And by the way, for those listeners, we are talking 2 weeks before the U.S. presidential election.
Well, clearly the election will be pivotal, but not in the ways that I think people assume. Okay, both candidates are very, very willing to spend money. And if there is a situation that unfolds where the White House and the House of Representatives are controlled by the same party, 2025 can be a year of fiscal stimulus. Right now, I think most people we're thinking that 2025 would be the year of monetary policy stimulus, and 2026 would be the year where fiscal stimulus would be come into flavor. I think now we're sitting back and thinking, well, how much monetary policy stimulus we're going to get. So is there really a risk of fiscal stimulus? And yes, if the White House and the House are in the hands of the same party, it's easy to buy a vote or two in the Senate because you have the tie-breaking vote with the vice president. So you could easily get something done. So 2025 may be a year where we're surprised by fiscal policy. And to the extent we're surprised by fiscal policy, that then becomes an important determinant as to how much monetary policy adjustment we're going to get and where do interest rates go in general.
So talking about monetary and interest rates, the Fed chairs, I think, in our world and perhaps broader than the banking world have kind of achieved this celebrity status of sorts, so to speak, with eyes following the dot plots and the speeches. And which chairs, and given kind of your longevity on the street, do you think have navigated crises well, and why?
I think you have to take it from the regard of accomplishing what they wanted to accomplish. Paul Volcker, going back to the early part of my career, was faced with a problem, and that was basically because we were targeting interest rates, which was a Keynesian concept, and those interest rates are so public, it became a restriction on the ability of Fed policymakers to change policy. And he needed a way to break that cycle. And so he opted for money supply targeting. Take interest rates out of the picture. Tell everybody we're not targeting interest rates. We're targeting money supply. And because we're targeting money supply, this gave them the opportunity to do what they needed to do in terms of interest rates. It was a great sleight of hand. It worked beautifully. And the fact that they actually accomplished the deceleration in inflation and the fact that inflation had been so high when it happened, it then opened the door.
Do you remember what it was?
Oh, yeah. I actually remember when the Fed did match sales at 24% one night and they closed out at 26%. I remember my first boss on the street retired on the 14 and a quarters of 2025. So, it is 2014, excuse me, the 14 and a quarters of 2014. The reality is I remember interest rates very, very well at that time. I was buying GMAC commercial paper from my own account at 18.5%. So it was a great interest rate environment. For some people, horrible. For others, if you had a mortgage. But the point really was he diverted the attention from the interest rates. That then gave Alan Greenspan the opportunity to be much more flexible in terms of interest rates because people remembered how bad inflation was. Over time, as inflation kept on going down and monetary policy began shifting more and more back to an explicit interest rate environment, this has then created a renewed process here where I think the market is back to the point where the interest rate decisions are so politicized that this Fed is actually transiting us from an interest rate policy to a forward guidance of policy that allows them to be more variable in the interest rate environment that's discounted in the marketplace. And I think this is Jerome Powell. So I give him a lot of credit for what he's doing in that regard because going after forward rates allows him to not necessarily change the current Fed funds rate, but affect the economy through the forward structure of interest rate expectations.
Is that what you mean when you say that the Fed is dominated by political economists as opposed to academic economists?
There's twofold to that. The concept of being academic economists versus a political economist really comes down to the way in which they're approaching it. The academic economist was really, really steeped in the old days in terms of the concept of monetary policy, the importance of monetary policy, the need to control inflation, because we had to battle stagflation. And that was public enemy number one. And it really got out of hand. And again, that's the reason why I went to graduate school. The world was a mess. Right. So the net result is for all of us who are that ilk, that became a real problem. Over time, as inflation came down, economists have varied their interests away from these concepts to other concepts where they could write dissertations on. First, it went from being, you were writing about macroeconomic theory, then you were writing about econometrics in dissertations, then you were writing about financial theory because the capital asset pricing model, Black-Scholes were all coming about. Then we got into the whole concept of using mathematics for financial engineering. After we were done with that, well, where do you really go? You started going into social economics. And we started looking at welfare, with the economy seeing this divergence between lower income and upper income households. It became a hot topic. It became an easier way to write dissertations. And when you look at the people that are in the senior positions at the Federal Reserve, you look at the staffs, you look at the members of the board, a lot of them wrote their dissertations, if they did them, on political economic theory. And that's what they want to play with these days. They want to try to move the levers around to see whether they can craft a better macroeconomic environment that lifts all ships as opposed to just some.
I can argue that it's happening in other areas of the government as well. Antitrust is one, sure. But that's a topic for another podcast, perhaps. So, in September, so it was a little bit ago, the CEO of the Eurasia Group spoke at the Mizuho Dealmakers Forum, and he commented He grew up in Iran during the revolution, where he saw firsthand the impact of politics on the overall economic activities and people's lives broadly. And he said that, if I'm quoting him correctly, that we're currently in a geopolitical recession that can last generations, and that people feel disconnected from their governments and their democracies. Not going to ask you to comment on his, but again, given the fact that we are in this election year, and I think you mentioned one of them before, but maybe from your perspective, what are like one of the 2-3 things that I think that are the most important topics, so to speak, in this economic cycle?
Yeah, I think the important topics...
Not economic cycle, pardon me, the election cycle.
Okay. In terms of the election cycle, I think what really is manifesting itself is the fact that we do not require the news media to be fair and unbiased, which, to be honest with you, goes back to Ronald Reagan. Because when Ronald Reagan, deregulated the airways, that was one of the things that went by the wayside. And the net result is we have wound up with a polarized news system. And we've also wound up with the evolution of technology to a 24-hour-a-day, 365-day-a-year news cycle, which needs information to continue to attract audiences. And therefore, it has continued to lead to more and more sensationalism, which I would say has almost become tabloidism of the entire news media. And I think that's a key aspect of what's going on in here. So it's hard for people who are new to this, or even ones who grew up with it, to understand what is truth and what is not truth, right, especially with the way it's presented in so many different forms. Do I think it is a long-term phenomenon? Yes, I do. But I think over time we're starting to see that certain aspects of this do better from a financial standpoint and certain aspects don't. And I think we will weed out the better from the worse. So I'm a little bit more optimistic that it's not going to take decades, but I don't think it's something that's going to go away in the next 3 to 4 years. So
maybe to wrap it up, for those thinking about a career as a chief economist, what advice would you give someone coming into the profession?
Mathematics, because it's all mathematics. When I started, when I applied to graduate school, for economics, I didn't really have the credentials to go into a graduate PhD program in economics, but they needed mathematicians because the economics was evolving rapidly and the mathematics was evolving rapidly, and they needed people. They could teach you the economics. The math was the hard part. And since then, it's gotten nothing more than more mathematical. And therefore, if you want to do this for a living, and if you want to do this in our industry, you need to understand all of the products. And that's important. And the bulk of these products are financially engineered products. And unless you can understand financial engineering, and again, I lived through the whole growth of this. I remember when the mortgage market was a function of Fannie Mae and Ginnie Mac prepayment books that were sent out once a quarter, and you sent somebody to D.C. to go to the information office to buy the books in cash and then run to a payphone to call in 3 or 4 prepayment numbers. So it's evolved dramatically. And the point is, it's all mathematics. The entire market is mathematics.
We'll end on this note.
Cheers.
Thank you so much for joining us.
Pleasure.
Pleasure is all mine. Thank you. Thank you for joining us on this episode of Storytellers in Business. If you enjoyed today's conversation, make sure to subscribe to Mizuho Storytellers in Business on your podcast platform of choice. You can also find us on LinkedIn by searching for Mizuho Investment and Corporate Banking, where you can follow us and add comment to our posts about this series. Thank you again for tuning in, and we hope you'll join us next time.
This podcast is for informational purposes only and should not be copied, distributed, published, or reproduced in whole or in part. The information contained in this podcast does not constitute research or recommendation from any Mizuho entity to the listener. Neither Mizuho nor any of its affiliates make any representation or warranty as to the accuracy or completeness of the statements or any of the information contained in this podcast, and any liability thereof, including in respect of direct or indirect or consequential losses or damage is expressly disclaimed. The views expressed in this podcast are not necessarily those of Mizuho, and Mizuho is not providing any financial, economic, legal, accounting, or tax advice or recommendations in this podcast. In addition, the receipt of the podcast by any listener is not to be taken as the giving of investment advice by Mizuho, nor to constitute that person a client of any Mizuho entity. For additional disclaimers and regulatory disclosures, please visit MizuhoGroup.com, Americas.